You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. Today, we're going to be discussing a very interesting topic, and that is what if certain deductions were actually indexed for inflation? What type of impact would that have on real estate investors' tax situation? I know one of them is going to be pretty big, is going to be the 25K special loss allowance. Believe it or not, that has not been indexed for inflation ever. So we're going to be diving into that and a whole bunch of other deductions in just 1 minute. Hey, are you an investor looking to slash your tax bill? Then get ready to discover everything you need to know about the short-term rental loophole to save up to 5 to 6 figures in taxes with our comprehensive STR task course. Valued at $247 is now just $1 for a limited time when you sign up for our Tax Smart Insiders community. Here's what you'll get when you sign up. Learn tested methods that have helped thousands of investors maximize their tax savings, get expert guidance and support from our team of real estate CPAs, and enjoy unlimited access to the course materials. Don't miss out on this incredible limited time offer. Visit www.taxsmartinvestors.com/free STR course to enroll today. Again, that's www.taxsmartinvestors.com/free STR course to enroll today. We'll see you there, but for now, we'll dive right into today's episode. All right, and we're back. So we're joined today with Justin Shore. And the interesting thing is the concept for this episode came about. Justin and I were talking on the boardwalk at Disney, and he mentioned something along the lines of, well, did you know like the 25K special loss allowance was never indexed for inflation? And I was kind of like thrown off by that. So Justin, do you want to kind of take us through a little bit about what the 25K special loss allowance is, what it means to real estate investors, and what it would mean if it's actually indexed for inflation?
Yeah. So back in 1986, when the passive loss limitations were all put into place, there was a little caveat that was inserted. And as we talked a lot on the show before about, passive losses versus non-passive income and using things like real estate professional status to work around that. And that's not what we're talking about today. But the focus is on passive losses and this concept. And when they first put this into place, they said that if you had passive losses, but your adjusted gross income was below a certain threshold, then you would be able to take those passive losses and use them to offset your non-passive income, like your W-2 income. So like if this sounds familiar, it kind of sounds like reps a little bit. But the idea there was that if your adjusted gross income was below 100,000, so more or less saying that if you were not a high net worth individual, you don't have really high income, the IRS was allowing you to take a little bit of these passive losses and offset some of your income. Now, the limit that they put on that was $25,000. So again, real simple recap. If your adjusted gross income was below 100,000 and you had real estate losses that were passive because you're not a real estate professional, you could take up to $25,000 of those losses to offset your W-2 income. Sounds pretty great. Now, that was 1986. So here we are, almost 40 years later. And the interesting thing, the point that we're kind of driving at today is that figure, that $25,000 figure has never been adjusted for inflation, which if you just kind of think back to, okay, now, some people might be listening and think, yeah, $25,000 in losses on my real estate isn't huge. It's not super exciting. But if you can kind of put into perspective of what $25,000 was back in 1986, it was pretty darn substantial for a lot of taxpayers.
Absolutely. And it's kind of crazy to think that that's never been indexed, right? So what we did was before the episode, we went ahead and kind of indexed some of these numbers for inflation. And what you'll find is quite interesting, right? So 25K indexed using the CPI as of 2023, it would be $69,675. As we were talking about before the show, it's almost triple the amount that it was in 1986. Imagine they did index for inflation. Let's just say it was $70,000, say, or 75K. Now, we've worked with a lot of real estate investors. I know Justin and Ryan may have some more recent data on this, but I would venture to say that many investors would not need the real estate professional status, or it'd be less relevant for them to try to qualify if this was actually indexed for inflation, was actually $70,000 today.
Yeah. And we can actually probably thank our lawmakers for our business today because they haven't indexed it for inflation and everyone's looking to how to claim real estate professional status in the short-term rental loophole. So thank you. But also for those of us, all three of us here are also investors. It's like, well, no, thank you for this because we would have loved to have been taking these losses as well. So it's kind of two sides of the coin there. And just imagine too, if they had been indexing this and real estate professional status had been less relevant for investors to try to pursue and like trying to understand it and what do I document, not only the pressure that would take off investors, but also the pressure that would take off of audits and take off of CPAs like us, right? Trying to explain it and document and all these things, just like the, I don't know, total kind of impact that would have as far as all these other strategies that we talk about. Just kind of thinking about that before the show too, how different that would look. But yeah, the 25K instead of the 70K, that's massive. And I think for even, people and we work with, day to day, it's like they could be taking that every year, right? Have no passive losses for the people we're looking at. And some of our clients, for sure, they've got much bigger losses that they have, and they would be suspended. They'd be looking for real estate professional status or the short-term rental strategy. But the other thing I'll just throw in there is the phase out income, right? Before it was 100 to 150. That was kind of the phase out range. The CPI that you ran, Tom, was about 279,000, kind of replacing the 100,000, and then about a 418,000 kind of top, which would be replacing the 150. So again, as people think about, their income bracket, a lot of people making less or in between, even if you're only taking a part of that 70 grand, again, still would kind of mean so many taxpayers would be using those, would now be passive and suspended, that actually be using that today and not have this massive bank of passive losses.
Right, exactly. Yeah, and just kind of recap, like what Ryan's saying there is that original phase out range started at 100,000, and if we index that up now to today, it would be that basically saying that if your income, your AGI was less than 278,000, 279,000, give or take, that would be the threshold to be able to use the passive loss allowance, which is pretty huge. Because I think we have that, like we were saying that with a lot of clients, that when they hear, 100,000, you get phased out on that pretty darn quickly. But if we actually kind of looked at how many more people would be able to take advantage of it if the threshold was in that $270,000, $280,000 range, it would encompass a lot more of the population for sure.
Yeah, it's kind of sad to see that they don't do that. But, at the end of the day, it is what it is. This is probably the most impactful one for real estate investors, at least in my opinion, for what would help the most people. And it actually kind of makes more sense. These numbers kind of make sense for today, if you think about it. But there's more than just the special loss allowance that has not been indexed for inflation. So we also have the Section 121 home sale exclusion, which is at $250K or $500,000 if you're married, that you can exclude on your primary residence, right, of your capital gain if you lived in your house for 2 out of the last 5 years. And we know there's all types of exceptions and partial things you could do with that. But the reality is that was enacted in 1997. And that has also not been indexed for inflation. And we know how the home prices have gone up, especially over the last handful of years. So much so that if that was actually indexed for inflation, that 250,000, if you were single, would actually be 477,500, or 955,000 on the top end if you were married, right? Think about it, almost 500K and $1 million, which I don't know about your guys' opinion, but in my opinion, that actually looks a lot more relevant for today. That actually seems a lot more like what you'd actually want to see in today's environment.
I think for Tom, you're in New York, so I could foresee in booming years, that might be more relevant, or California, like our clients who are on the coast, they might see something like that significant. I've had certain clients where thinking through kind of the Section 121, and we're kind of playing around with, okay, do we kind of use a combo strategy of the Section 121 plus a 1031 because the gain is so high? And we're kind of thinking through alternative strategies, which is fun as a strategist to do that. But if it were that large, especially for people kind of where real estate has appreciated significantly, I could see that being relevant. Me and Justin are in the Midwest. To see a gain like that in 5 years would be pretty significant. So I think it depends even just where you are region wise as far as how much that would get used, because right, you could do this 2 of the last 5. So literally it's every 2 years you could be getting this massive amount of gain being excluded on a primary, right? You got to meet the tests. 2 of the last 5, you own it and you live there as your primary. But point is I think it's most relevant for those really high appreciating states and areas. For maybe a lot of the rest of the country, that's that's really excessive. So maybe for a lot of people that won't be as relevant. But Justin, what do you think?
Yeah. No, I totally agree. I mean, if you just kind of look at it from relative perspectives, right? If you're looking at, something, a three bedroom, 2 bathroom home, say, in California, that maybe, market price would be 750,000, but then in a smaller market in the Midwest, maybe it's 350,000 or something like that, that even if you just look at a 5-year run up kind of period on that, it's obviously like much more likely that the price point starting at 750 could climb more than 250,000 in a few years for a single person. I'm sure a lot of people like on the West Coast actually, experience numbers like that. Whereas, the home in the Midwest that maybe was 350, maybe it only went up $150,000 in value, maybe relatively similar percentages. But since the 121 exclusion is a dollar amount threshold specifically, it's easier to exceed those in those like larger coastal markets and stuff like that. What I think is kind of interesting, and this is relevant for what's kind of happening right now with politics too, is one of the proposals that's out there is to offer a tax credit to taxpayers that are either buying their home or they're also wanting to offer a tax credit to some people who are willing to sell their homes as well. And I think it's interesting because they could accomplish a very similar goal much more easily and on a much more broad perspective by doing something like this, by just adjusting that home sale exclusion, the 121 exclusion, for exactly what Ryan was just saying, is that $500,000 threshold for a married couple could be exceeded in a lot of these bigger markets that just have higher cost of living. And that proposal to offer people tax credits for selling their homes is only $10,000. So again, putting that in relative perspective here, someone selling a home for $900,000 or $1 million on the coast, $10,000 is kind of a drop in the bucket when it comes to the actual sale price of the home and the price of them buying another home. Whereas it might be really helpful for someone in a smaller, lower demand market like in the Midwest. So they could get a much broader reach, I would say, if they just expanded the 121 exclusion. You at least get a lot more inventory opening back up in the market since we have such a big housing shortage.
Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Hall CPA, we worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2023 and 2024 tax years, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help. But for now, we'll dive right back into today's episode. Well, we better get right into the congressman, the House of Representatives, and see if they can get cracking on some of this stuff. No, I'm kidding.
That's kind of the theme of today's episode, I think, is everybody's got to get out there and start writing your congressman.
We want the 25K special loss allowance indexed for inflation. We'll get to some of the dark side of things of what's not being indexed for inflation that could actually hurt people. But another one that I found really interesting, so I looked this one up. The business gift deduction was actually enacted. So you're allowed to deduct up to $25 for business gifts per person. So for example, we say I gave Justin a gift and it was a business expense. I can only deduct up to $25 worth of that. That was actually enacted in 1954. All right. So I want you to consider that's a long time ago. And at this point, it's not been indexed for inflation. If it was indexed for inflation today, it'd be around $285, which covers a lot more of gifts that you can give if you think about it. I mean, like $25 really can't go that far these days. You can maybe give them an Amazon gift card or something like that. But it would be interesting to see that index for inflation.
Yeah, I can't talk Tom into sending me that, nice bottle of scotch if it's, only $25. It's not going to make it very far.
Yeah, no, I mean, to be clear, people do send gifts that are over $25. It's just sad to see that the deduction is so low and that it hasn't been updated ever since 1954, which is crazy to me. Which brings us into another deduction that impacts small business owners and real estate investors in some cases, and that is this deduction for startup costs, right? So when you first start up a business, you can deduct up to $5,000 in the first year, and then as long as your expenses are up to $50,000, if it's beyond that, your deduction in that first year begins to phase out. But if that was actually indexed for inflation, it would be $8,100, $8,100, and the limit would be $81,000. Now, it's not too much more impactful, but it's still just something it would be nice to see, have it being indexed for inflation. Then we have a few other ones here. We have the lifetime learning credit and the student loan interest deduction, which I know impacts a lot of doctors and medical professionals in particular due to the student loans. I know I've worked with a lot of clients who were in this situation. The lifetime learning credit was enacted in 1997. It was never updated. It's currently 20% of the first $10,000 of qualified education expenses with a maximum credit of $2,000. If that was indexed for inflation, that would account for roughly $19,000 of qualified education expenses and a maximum credit of roughly $3,800 as of 2023, which I know, again, would help a lot of people who are doing continuing education and going to college and things like that. So the last one we'll cover for today is the student loan interest deduction. Then we have the dark side of some deductions, and then we will actually have some other interesting things about inflation for some things that actually have been indexed for inflation. So we'll be diving into that as well. All right, so for the student loan interest deduction, that was enacted in 1997. It was never updated. It is $2,500, and if it was indexed, it'd be roughly $4,800 or so if you round up. But that would be a nice almost double if you want to think about it like that, for the amount of interest that you can deduct for your student loan interest. And I know that would help a lot of people. So it's interesting to see if that will ever be indexed for inflation, but it currently has not.
And I'm pretty surprised by those last two, just with how much push there has been in recent years for things around things like student loan forgiveness, for example. So it's kind of surprising that neither one of those has ever really made its way back to the table or whatnot. It seems like that would be a happy middle ground to land on. So maybe someday we'll see that.
I'd like to see that done, expanding the student loan interest deduction and perhaps the lifetime learning credit. I know there's another one, the American Education Credit, if I'm not mistaken. I'd like to see those expanded rather than see loans forgiven. I might get some flack for that one, but I think that's in my opinion, that's a more reasonable way to handle that than to just start forgiving people's loans. But that's just me. But now we get into the dark side of things, right? So one thing that's not been, and I know this isn't directly tax related, but I know there's been a lot of chatter about this in various capacities, but the accredited investor status, right? To qualify as an accredited investor and be able to invest in 506c syndicate and fund offerings, you need to either be making $200,000 or more for the last 2 years with the expectation of making it the same or more in the third year. If you're single, if you're married, that's $300,000, or you have a net worth requirement of $1 million. Now, that was also put together in the 80s or 90s, but if you look back at it, right, if that was indexed for inflation, that would actually be $634,000 if you're single, or $951,000 if you're married, and the net worth requirement would go from $1 million to $3,170,000, which would decrease the amount of people that could get access to the accredited investor status and these other investments. And these numbers actually make a lot of sense for the purpose of that, right? They're trying to stop people they basically didn't want people who didn't have disposable income, right, to be investing in these riskier deals where there's less transparency and where they could particularly perhaps lose their shirt. However, something I did want to note is today, at this point in time, they're actually trying to ease those limits for the accredited investor status, not the income limits per se. They want to make it more accessible by giving people a test. If you can pass a test, then you will qualify as an accredited investor. So it doesn't seem like they're actually trying to make it more challenging. They're actually going in reverse. But I just wanted to put this here to illustrate that if certain things were indexed for inflation that are not being indexed for inflation, it could also just as well go to the disfavorable side for some people, depending on how you want to look at it.
Yeah, for sure. I was just speaking with a client yesterday on the accredited investor thresholds or limits, and they were unaware but very surprised that was going to be something that was going to limit them from being able to make some of those what they would consider like alternative investments. They're kind of disappointed they're running into that barrier. So it'd be great to see that opened up a little bit more too.
Yeah, and I think the SEC is actually, I think Congress or the Treasury, perhaps, I forgot exactly who, they handed down to the SEC like a mandate to create a test within the next few years. Because they do want to make these more accessible. And I think that might have came as because if you pass the Series 6.5 with FINRA and a few other licenses through FINRA, you could actually also be considered an accredited investor. What I find interesting is that I think a lot of people are trying to go for like that Series 6.5, create a registered advisory firm just to become accredited. And they're probably like, it probably just makes sense just to give people a test. Like if you can pass this test, you could show you have the requisite knowledge and understanding on how these investments work, what the risks are, so on and so forth. Then you should be able to go ahead and invest. And I have to agree with that. I'm very much like, if you want to invest, why not? Right? As long as you understand what you're getting yourself into. But I know before the show, Justin, I know we were talking about some of the other positives of things that were indexed for inflation that are actually currently being indexed. Do you want to kind of go through some of those?
Yeah, absolutely. So, I mean, I think one that definitely benefits everybody, that is kind of a nice thing, is the long-term capital gains brackets. The actual like where the income levels or thresholds are for each one of the brackets is adjusted a little bit each year. So that's very helpful. We've got ideally maybe income stepping down into 15%, sometimes 0% capital gains brackets. So at least that one's something that actually goes up a little bit every year. And another one that we've talked about is just a now I don't want to say an easy deduction that a lot of people can tap into, but something that doesn't hinge on things like real estate professional status, is the annual maximum contributions to HSAs goes up a little bit each year. So thankfully they've not kept that static like some of these other factors. And another interesting one that goes up a pretty decent amount every year is the thresholds for the qualified business income deduction. And for anyone who's not aware, the qualified business income deduction was part of the Tax Cuts and Jobs Act and is a 20% deduction off of your qualified business income, as long as you're below certain AGI thresholds. And there's a litany of other tests and the special service trade or businesses or whatnot that have to be kind of considered in that as well. But it's nice that we, are consistently seeing that climb a little bit, which is allowing more and more small business owners to take advantage of that large, because it's a pretty hefty deduction. That would be something that would potentially go away after 2026, but we got a long way to go before we have to worry about that actually coming to pass or whatnot. Again, if Congress decides to extend that would be fantastic. Maybe they will, maybe they won't.
And a couple others too. 401ks continue to go up pretty much every year. Kind of along with that, the IRA contributions, traditional or Roth, but overall the IRA contributions you can do. Standard deductions have been moving up. That's a plus. That's a good. Some of the overall just like tax brackets have also been going up every year. Obviously the tax rates, that's something that politicians like to play with. Do we do 37 as the top rate, or 39.6 is for some reason the top rate? I don't know why we just don't go to 40, to be honest. Like, why is every other rate end with a round number, but this top one has to be point something?
Well, what do you think's cheaper, $19.99 or $20? Right? it's the mental game. If they go up to 40, well, it's all of a sudden 40%. If it's 39.6, it's under 40%.
Marketing, I guess. Even our lawmakers like to use this tactic. But one too that I think would be interesting to talk about too, guys, is the Social Security wage base. And we were talking about that also before the show. But so for example, 2022 income at 147 or below still had to pay the full Social Security income tax. 2023, that goes up to 160. And then 2024, it's about 168.6. So that continues to creep up. So the amount of tax that they're gathering is just kind of, as your income might be increasing over those years, essentially you might be right around that threshold, and then they increase there and you're like, I still have to pay all of that, Social Security income, which who knows? Who knows where Social Security is going, overall. But I think that's going to continue to increase. And I don't think that's going to be changing at all. That would be one that would have been nice if that had not been adjusted for index or inflation, excuse me.
Sure.
And what's interesting with that one, with the Social Security wage base, is, if you're looking at that, if you're listening to this as a W-2 employee and thinking, okay, I'd love to set my goal as getting my W-2, over that threshold. It's where basically, like what Ryan was saying, is this year the threshold is 168,600. So if your W-2 is any amount above that, you're getting basically like a discount in a way, because you're dropping off the 6.2% additional tax for Social Security that's normally taken out of your paycheck. So what's interesting on that, though, too, is it's a benefit to the employers as well. Because what a lot of W-2 earners don't realize is your employer is actually matching that amount. They're incurring that same 6.2% on everything that they pay you. So this is even for everyone running a business with employees out there, is there's actually some incentive there for you too. You could think of it as a way as you're getting a little bit of a payroll tax discount on the wages that you pay to your employees. The better that you pay them, the further you get them over this $168,000 threshold, which they, again, kind of keep us chasing our tails a little bit with that number going up a little bit every year. But I think that's kind of a interesting background incentive for, companies to, they're incentivized to pay their employees even more, as they're getting a small discount once they get over that threshold. So that's kind of interesting.
Keep that in mind, Tom.
Yeah, yeah.
Yeah.
Well, if you're
There you
selling,
go, everybody. Take that to your employer and then let them know that the tax advisors out there have told you got to pay you more than 168.6 this year.
I see what you're saying there. I mean, because like the employer, because as the employer, when you're paying the FICA tax, you have to pay the other half, right? So that keeps creeping up. But once you kind of get over that threshold, you're not paying as much. But if you're self-employed or you're part of a partnership or something like that, you do have to pay both sides of that FICA tax. So that 15.3% up to that number, which just keeps creeping up. They just keep wanting more and more. So yeah, that's not so exciting. That's the dark side of indexing for inflation for sure. But it is what it is. We covered a lot on this episode. Was there any other particular ones you guys wanted to drill down on before we kind of summarize and wrap this one up?
Yeah, one that we could throw in there, and we won't talk about this as often on the real estate side of things here, but I was just talking to a client about this afternoon, is the Section 179 amounts are actually indexed for inflation as well. So there's two figures there. There's one, the maximum amount that you can take in 179 expensing for the year. But then there's also, like with a lot of these other ones we've talked about, there's a phase out threshold as well. But, to give you an idea, I think it was 2021, it was right around a million, pretty close to a million even, was the most that you could take in 179 expensing. And like 2024, it's up to 1,220,000. So that's a pretty decent increase. Now, part of the reason why we don't look at Section 179 expensing as often is because Section 179 expenses cannot produce a tax loss. So, comparing that to bonus depreciation, which does allow us to create tax losses. But 179 expensing can be really, really useful, really powerful when you have, a business that is a little bit further, I don't want to say all the way to its maturity stage, but when you're pretty regularly operating in the black, so to speak, where you have a decent amount of taxable income that you're trying to offset. And maybe that is with real estate, but maybe it's that you're 6, 7, 8 years into your investing journey. So you have a decent amount of taxable income from even like rental properties that maybe now you can benefit from 179 expensing because you've got plenty of taxable income to absorb it. So that one can be pretty hefty. And as bonus depreciation goes down, I think we're going to see a little bit more interest or attention on Section 179 expensing.
Yeah, we'll definitely have to see how that works. I know it's something that we haven't covered in depth here on the show, Section 179. So maybe we'll have to do an episode on that in the future and just kind of flesh that out, especially as you said, Justin, as bonus depreciation begins to phase out. I'm still interested to see if bonus depreciation comes back at 100%, but we'll have to wait and see on that as well. That's just a side note. I think the big takeaway for me from this episode and what kind of little light bulb up in my head was when Justin first mentioned it to me was the 25K special loss allowance. Like if that was just indexed for inflation, that would make a lot of real estate investors' lives a lot easier. They'd be able to keep more of their money in their pockets, higher amounts of cash flow, more money to reinvest, less pressure to qualify for reps, less pressure to use like the STR loophole if it's not really up their alley. And it's sad to see that something like that that's so powerful has not been indexed. I'm tempted to write to Congress about that. But my concern is if a bunch of people started writing to Congress about that specific issue, is what type of rocks would that unturn, right? Because I don't know how sophisticated most of Congress is about when it comes to tax policy, but they might look at that and say, that's interesting. What else are we not indexing for inflation? What else could we index for inflation that maybe would not be so beneficial? So that would be my concern. But definitely very interesting. And hey, if we want to get your input on this, join the Tax Smart Investors community by going to www.taxsmartinvestors.com/Facebook and drop us a comment when this episode goes live on Facebook, or drop us a comment on YouTube. Just search for Tax Smart Investors on YouTube. I want to hear from you. What do you think? Do you think the 25K special loss allowance should be indexed for inflation, or do you think they should leave it the way it is? That'd be an interesting topic to hear more about. But we covered a lot in today's episode. One thing that I did not mention is that this is completely theoretical here, completely hypothetical. There is no talk about any of these items that we've mentioned that have not been indexed for inflation for them to be indexed for inflation. So I don't want to have people out there saying, oh my God, did you hear on the Tax Smart REI podcast that they said that this stuff is going to be indexed for inflation? As far as we're aware, it's not going to be indexed for inflation as much as we may like it to. So Justin, I want to thank you for joining us on the show today. It's always a pleasure to have you on to break down this stuff. If you are interested in becoming a client, if you are not happy with your current CPA or you're looking for someone who specializes in real estate, we can certainly help. We'd love to learn more about your situation and see how we can help. Just navigate to www.therealestatecpa.com/podcast, fill out the brief form on that page, and our team will follow up with next steps. And of course, if you're a CPA, you're an EA out there, you have tax experience, and you're looking for a change, looking to work for a firm that's on the cutting edge, we'd love to hear from you as well. Just send us an email at onboarding@hallcpallc.com with a copy of your resume, a position you'd be interested in, and why you'd want to work for our firm. We're always looking for top talents. We'd love to hear from you as well. That's about it for today's episode. We'll catch you on next week's episode of the Tax Smart REI podcast.